Hey guys, welcome back to the video. I'm Luke, an ACA qualified accountant, and in today's video we're going to discuss the Accounting Fundamentals exam. Specifically, we're going to look at the first long form question that you're going to face on exam day. We're going to run through a mock exam example, and I'm going to show you an 8-step process and framework that you can use to tackle this kind of question when it comes to your exam on exam day. So yeah, let's get into it. As part of the Accounting Fundamentals exam, you'll need to answer 2 long-form scenario-based questions which together will make up 40% of your overall mark. One of these questions, which is worth 25%, requires you to prepare a full set of financial statements from scratch using a trial balance, while the other scenario-based question is worth 15%, and that asks you to adjust and correct errors or omissions in a draft set of financial statements, which is either an income statement or a balance sheet. In this video, we're specifically going to focus on the first, more involved question, and over the course of the next few slides, I'll guide you through how to tackle this kind of question step by step using a worked example based on Noble PLC. Sound good? Cool. Let's get started. On the right-hand side of this slide, you can see that we've been provided with Noble PLC's initial trial balance as at 31st of December 20x1. Alongside this trial balance, we're presented with 6 additional issues which are outlined on the next slide that need to be factored in to the final set of financial statements. Your task is going to be to prepare a complete set of financial statements for the year ended 31st of December 20x1 using the trial balance and incorporating all relevant adjustments. Cool. So let's now explore the 6 issues that you'll need to adjust for when preparing Noble PLC's financial statements. Each of these issues haven't been reflected in the initial trial balance we've been provided with, and therefore we will need to factor them in when producing the final income statement and balance sheet. So let's briefly run through each issue in turn. Issue 1, we're told that closing inventory has a sales value of 900,000 and that Noble PLC applies a 50% markup to its goods. We know that inventory in the financial statements must be recorded at cost, not sales value, so we're going to need to strip out the markup to calculate the correct inventory value. Issue 2, the company paid £80,000 for an insurance premium covering the period running from October 20x1 to September 20x2. This £80,000 was recorded in full within distribution costs. Now, given that only 3 months of the insurance policy actually relates to the current financial year ending 31st of December 20x1, the rest, covering the period from January 20x2 to September 20x2, is going to be a prepayment, so we'll need to adjust for that accordingly. Issue 3, Noble issued 50,000 shares with a nominal value of 50p for a price of £2 each. We're told that the cash was correctly recorded in a cash at bank account, however the full £100,000 was allocated to the share capital account. Again, we know that only the par value should be recorded in the share capital account. Anything above that should be recorded in the share premium account. So we'll need to reclassify that portion through a corrective journal entry. Issue 4, income tax. So income tax for the year has been calculated at £25,000. This amount must be recognised as both an expense in the income statement and as a liability in the balance sheet, as company tax is paid in the following accounting year, not the current year. Issue 5, there's an outstanding environmental legal case ongoing against Noble PLC, and based on legal advice, there's a 65% chance Noble will need to pay a £40,000 amount to the claimant. Since there's a greater than 50% chance of Noble needing to pay out, and given the fact that the amount can be reliably estimated, this is going to qualify as a provision. So the cost should be charged to administrative expenses, and the liability needs to be recorded in current liabilities. And finally, issue 6, we need to account for depreciation. We're told here that there were no new non-current asset purchases or disposals that took place during the year. Plant and machinery are depreciated at 10% on a reducing balance basis, and that's charged to cost of sales, whereas motor vehicles are depreciated on a straight line basis over 20 years, and that's charged to administrative expenses. So we need to calculate and record both depreciation expenses accordingly. So together these 6 adjustments are going to transform the initial trial balance into a complete set of financial statements. So before we dive into answering the question, I want to introduce you to the structured step-by-step approach I recommend using when tackling this long form question in your accounting fundamentals exam. Here's the thing. These questions may look daunting at first, but in reality they're incredibly mechanical. If you follow a clear plan and a solid structure, you'll be far more likely to remain calm and methodically pick up easy marks as you go. What often causes candidates to struggle in the accounting fundamentals exam isn't necessarily a lack of understanding of the topics and of the material, it's poor exam technique. So what I've laid out here on the slide is a logical 8-step process I personally recommend using to approach this question in a time efficient and logical way. Feel free to adapt this approach to suit your own style, but whatever you do, make sure you go into your exam with a plan for how you're going to attack these types of questions, because across the board, what I see is that candidates perform far better when they go into this question with a plan and don't just try to wing it. So with that in mind, let's walk through each of the steps one by one. Step 1. Start by setting up 2 working calculations, one for cost of sales and one for retained earnings, and transfer the relevant amounts provided from the trial balance into these calculations. These are both key components of your income statement and your balance sheet, so get these 2 calculations set up first. Step 2. Transfer all the remaining balances out of the initial trial balance into your draft financial statements. So the goal here is to move everything out of the trial balance so you don't have to keep referring back to it. Step 3, now is time to tackle the adjustments. You're going to work through each of the adjustments in the order that they're presented in. You're not going to skip around to find the easy ones. You simply don't have time, and you need to address every adjustment at some point anyway. So you're just going to work through them in chronological order as they're presented to you in the question. Step 4, after you've been through each adjustment, factor them into your financial statement. So whether it's an expense, a provision, a depreciation charge, make sure that the journal entries have been reflected accurately in the income statement and the balance sheet. Step 5, once all of these adjustments have been processed, you can now finalize your income statement and calculate net profit. Step 6, you're going to use that net profit figure from your income statement to calculate closing retained earnings. Step 7, you're going to finalize your balance sheet. And finally, step 8, you're going to take a moment to confirm that your balance sheet balances. Total assets should always equal total equity plus liabilities. So yeah, if I were you, stick to these 8 steps, practice doing mock exam questions using these 8 steps, and I think you'll find this type of question becomes much more manageable and hopefully a lot less scary. Cool, so let's start answering. Step 1 of our 8-step process is all about setting up 2 key calculations, cost of sales and retained earnings. The aim of step 1 and of step 2 is to move every number out of the trial balance and into its proper place within the financial statements. By doing this, we're going to remain organised, and we're also going to avoid missing out any numbers from the initial trial balance and miss out transferring them into the financial statements. So as we transfer each amount from the trial balance into our formulas or our financial statements in step 2, we're going to highlight or tick off each item in the trial balance in the software to track our progress. Doing this is going to help us keep track of all the numbers and avoids missing out on transferring one or more items to our income statement or balance sheet. And again, you're going to be able to highlight all of the lines in the initial trial balance in the question in the exam software, so you can make sure that you're ticking off everything as you go. I should also say, I recommend you do all of your workings on a scrap piece of paper. Only use the software to input your final numbers when you're finished. In my experience, scrap paper is a far more effective tool than the ICAEW software when it comes to tackling these kind of questions. So yeah, I recommend doing all your workings on scrap paper, and then once you've got your final answer, only then just transfer that into your answer sheet in the software. So Let's begin with transferring numbers from the trial balance to the cost of sales formula. And the cost of sales formula, if you remember, is cost of sales equals opening inventory plus purchases minus closing inventory. From the trial balance, we can see that opening inventory is 1,974,000. Purchases are 6,384,000, and we haven't calculated closing inventory yet. That will come from our adjustments, which we'll look at a bit more in the forthcoming slides. So for now, we plug in what we know. We've got cost of sales equals 1,974,000 plus 6,384,000 minus closing inventory. And we leave closing inventory as a placeholder for now. So we can tick off on the trial balance our purchases, because we've transferred that across, and we can tick off our opening inventory. Next up, let's set up our retained earnings calculation. We know that closing retained earnings equals opening retained earnings plus profit for the period minus dividends. From the trial balance, we know that opening retained earnings is 361,000. We can tick that off. And dividends paid during the year were 742,000. So we write closing retained earnings equals 361,000 plus profit, which we don't know yet, minus 742,000. So again, we'll calculate the profit figure once we finalise the income statement, but this sets things up nicely to slot our profit amount in later. So that's step one done. We've ticked off 4 trial balance items. We've got opening retained earnings, dividends, purchases, and opening inventory. So we've set up those 2 essential calculations that we'll build on in the next few steps. Cool. Next up in step 2, this is where the financial statements really start to take shape. In step 1, we use the initial trial balance to set up our cost of sales and retained earnings calculations. In step 2, our goal is to transfer all of the remaining amounts from the trial balance to the financial statements, starting with the income statement, and then we'll do the balance sheet on the next slide. So again, the mindset here needs to be, we want to clear out the trial balance. As we move items out of the trial balance, we need to be ticking them off like we were on the last slide. So by the time we reach step 3, every number from the trial balance should either be in the cost of sales formula, in the retained earnings formula, or within the financial statements. So with that all in mind, let's start with the income statement items. We begin at the top with revenue, which comes straight from the trial balance. That is 15,738,000. Tick that off. Next, we have distribution costs of 1,015,000. And we have administrative expenses of 410,000. Again, we lift these directly across from the trial balance, drop them into their respective line items in the income statement, and then highlight them in the software so you know you've transferred them across. Then we also have finance costs, which are made up of the loan interest, which is 300,000. Again, we transfer that across from the trial balance. So in terms of gaps that we have in our income statement, first, cost of sales, that's going to be blank because we're going to calculate cost of sales, or finalise our calculation for cost of sales in a later step once we have our closing inventory. And income tax is also a gap as well, because that's going to be one of our 6 adjustments which we discussed earlier. So we'll leave that blank for the moment. So we've now moved a further 4 key items off the trial balance and into the income statement: loan interest paid, revenue, distribution costs, and administrative expenses. So that's a pretty solid chunk that's been cleared, and we're now well on our way to clearing out the entire trial balance. Let's continue on with step 2 by turning our attention to the asset side of the balance sheet. We start at the top with non-current assets from the trial balance. We can see that we have plant and machinery, which has a cost of 13,700,000, and it also has accumulated depreciation of 4,900,000. So we net those off against each other in the balance sheet workings column, which is 13.7 million minus 4.9 million. Next, motor vehicles, we have a cost of 2.5 million and 1 million of accumulated depreciation. So again, we need to net those two off against each other in the motor vehicles section. And we can tick those off. Plant and machinery cost, motor vehicles, accumulated depreciation. So, current assets. From the trial balance, we have trade receivables of 239,000, and we have cash of 1,085,000. So we can transfer each of these directly into our draft balance sheet. We'll revisit inventory a little bit later once we calculate the closing inventory amount from the adjustments. And again, just like the income statement, we tick off these 6 items in the balance sheet as we go through. And it's really important to do this in the software because the visual cue keeps you from missing or duplicating any entries in your answer. You'll also notice in our current assets section, we have a prepayment line. It's blank for now, and we'll fill it in a little bit later when we address the insurance adjustment in step 4. Now let's finish step 2 by filling in the equity and liability side of the balance sheet, starting with equity, which we transfer 2 figures across. From the trial balance, we have share capital of 2.1 million, and we have share premium of 500,000. Again, retained earnings will be populated later once we calculate net profit and once we've accounted for dividends. So we'll leave that blank for the moment. So that's the equity section sorted for now. Next we look at non-current liabilities, and from the trial balance we can see that we have an 8% bank loan which is repayable in 10 years, and that's worth 3.75 million. And again, since it's due in more than 12 months, it's going to go straight into the non-current liability section of our balance sheet. We can also have a brief look at current liabilities. You'll see we've got 2 placeholders for adjustments that haven't yet been posted. We have a line for a provision, which relates to the legal case that we mentioned, and also we have income tax payable, and that will be, we can update both of those items once we factored in our adjustments in step 4. So let's take a step back. By the end of step 2, you've moved every item off the trial balance, so it should be everything should be fully cleared out, and both your draft financial statements are ready for the adjustments. So with that in mind, let's dive into the adjustments and the associated journal entries. Our first adjustment is to deal with closing inventory. We're told that Noble's closing inventory had a sales value of £900,000. And the company sells its goods at a 50% markup. Now remember, inventory must always be valued at cost, not at its selling price. So we need to reverse out that markup, and to do that, we divide the sales value of £900,000 by 1 plus the markup percentage of 50%. And that equals £600,000. That's the inventory's cost amount. Now, we need to determine the journal entry which records that closing inventory. So to record closing inventory, we debit inventory by £600,000 because we need to record inventory as an asset on the balance sheet, but we also need to credit cost of sales by the same amount. That's going to reduce this year's expenses as we're removing the cost of goods sold for the period when we record closing inventory. So that's the adjustment that we need to post for the first issue that we're presented with, closing inventory. And that's going to feed directly into both our balance sheet and the cost of sales formula from step 1. Our second adjustment relates to prepaid insurance. Noble plc paid £80,000 in May 20X1 for insurance that covers the 12-month period, which runs from October 20X1 to September 20X2. But the issue is that the accounting year end we're preparing the financial statements for is 31st of December 20X1, which means that only 3 months of the insurance policy relate to the current financial year. The other 9 months relate to 20X2 and therefore need to be recorded as a prepayment. So the prepayment amount equals 9 months over 12 months times by 80,000 equals 60,000. And the accountant made a mistake. They incorrectly debited the full amount to distribution costs and they credited the payment to cash. That part was correct. But what they should have done is debited only 20,000 should have only debited 20,000 to distribution costs. They should have debited 60,000 to prepayments and credited cash 80,000. In other words, they only needed to expense 3 months in the current year, and they should have recorded a 9-month prepayment for the following year. So to correct this error, we need to put through the following adjusting journal entry. We debit prepayment 60,000 and we credit distribution costs 60,000. This ensures that only 3 months of the insurance expense is expensed this year and the balance is carried forward to the next period as a prepayment asset. Next up, we have a share issue that was recorded incorrectly. Noble plc issued 50,000 ordinary shares with a nominal value of 50p for £2 a share. This means that Noble raised £2 times 50,000 shares. They raised £100,000 worth of cash from the share issue. But only 50 pence times 50,000 shares equals 25,000. Only 25,000 of that amount relates to share capital at par. The remaining 100,000 minus 25,000 should go to the share premium account. So £25,000 worth of the share issuance should have gone to share capital, 75,000 should have gone to share premium. What the accountant did is they debited cash 100,000, which was correct. They credited the full amount to share capital. The full 100,000 went to share capital. What they should have done is debit cash 100,000, credit share capital 25,000, and credit share premium 75,000. To fix this mistake, we need to put through the following correcting journal entry. We need to debit share capital 75,000, and that removes the amount which share capital was overstated by, and we need to credit share premium by 75,000, which accurately reflects the amount that should have been recorded in the share premium account. So this reallocation ensures that share capital reflects only the par value of the issue, and the excess is correctly classified as share premium. They're both part of equity, but they are presented separately. Our fourth adjustment relates to income tax. We're told that the company has calculated its tax for the year as £25,000, but that amount hasn't yet been recorded. Because it relates to the current year, we need to post debit income tax expense £25,000. This is going to go to the income statement, and we need to credit income tax payable £25,000, which is going to create a liability on the balance sheet. And this is a classic accrual. The tax has been incurred in this financial year, but won't actually be paid until the next financial year, because companies always pay the tax that they owe for the current year in the subsequent accounting year. That's why it's so important to make this adjustment manually, because it ensures the financial statements reflect the tax expense in the current period. The fifth adjustment relates to a legal case which is pending against Noble plc. We're told that the lawyers believe there is a 65% chance that the company will need to pay £40,000 to settle the claim. Now remember, under accounting rules, if a liability is more likely than not to be incurred and the cost can be reliably estimated, we need to create a provision. So to do that, we debit administrative expenses by £40,000. This hits the income statement, and we need to credit provision £40,000. This shows up under current liabilities in the balance sheet, and this reflects the fact that the company expects to pay this cost in the future, even though it hasn't yet been crystallised. Provisions like this are common in financial statements, and being able to recognise them is a key ACA accounting fundamentals exam skill. Our final adjustment in step 3 is for depreciation. So we're told that plant and machinery are depreciated at 10% per year on a reducing balance basis, and depreciation on plant is charged to cost of sales, whereas motor vehicles are depreciated on a straight line basis over 20 years, and depreciation on vehicles is charged to administrative expenses. So let's calculate the depreciation charges as follows. For plant and machinery, we use the reducing balance method. So we take the carrying amount, which is the cost of 13.7 million minus the accumulated depreciation of 4.9 million, and we multiply that by the depreciation rate of 10%, which equals 880,000. For motor vehicles, we use the straight line method, so we take the cost of 2.5 million and divide by the useful life of 20 years to get an annual depreciation charge of £125,000. Now let's think about the journal entries. For depreciation of the plant, we need to debit cost of sales by 880,000, and we credit plant and machinery again by £880,000. For the motor vehicles, we debit administrative expenses by 125,000, and we credit motor vehicles again by £125,000. This ensures we capture the wear and tear of the company's assets over time and match their usage to the periods that they benefit. Let's begin step 4 by updating the income statement with all of the relevant adjustments we just worked through. First, we need to adjust cost of sales. For closing inventory, we calculated closing inventory as £600,000, and the journal was debit inventory, credit cost of sales. So we need to reduce our cost of sales amount by 600,000. So in the cost of sales formula, we now have opening inventory of 1,974,000 plus purchases of 6,384,000 less closing inventory of 600,000. And because we've processed that credit entry, that credit cost of sales, we can tick it off. Second, we update distribution costs. We calculated that 60,000 of the insurance was prepaid and shouldn't be expensed this year. And the journal was debit prepayment, credit distribution cost 60,000. So we need to reduce the distribution costs in our workings column by 60,000. And we can tick off that credit distribution cost adjustment because we've processed that now. Third, we move on to income tax. The income tax expense hasn't been recorded for the period, and we determined that there was an adjustment of debit income tax expense 25,000, credit income tax payable 25,000. So we can now show the income tax expense of 25,000 in the income statement. We also need to account for the legal provision, so the expected cost is £40,000, and we're told to charge it to administrative expenses. And finally, we need to factor in depreciation. So we calculated 880,000 on plant and machinery. That's charged to cost of sales. And again, and we also have £125,000 worth of motor vehicle depreciation, which is charged to administrative expenses. So we can tick both of those off. We've processed those adjustments. Again, be sure to highlight each journal entry as you process it, because it's going to help you keep track and ensure that every adjustment has been properly reflected in your financial statements. Let's now turn to the asset side of the balance sheet. First, we're going to apply the inventory adjustment. So we debited inventory with 600,000, which now becomes the closing inventory on the balance sheet. Second, we post the prepayment for the insurance expense. That's a £60,000 current asset, and that represents the 9 months of insurance coverage that relates to the next financial year. Next, we need to factor in the depreciation. So for plant and machinery, we need to reduce its value by 880,000, and motor vehicles we reduce by 125,000. So that's everything on the asset side of the balance sheet. Let's now move on to equity and liabilities. Again, we're just continuing to work through the adjustments until everything's been factored into the financial statements. So now we can look at the share issue error. The accountant originally overcredited share capital. Of the £100,000 raised, only 25,000 was par value. The remaining 75,000 should have gone to share premium. So we need to debit share capital, and we credit share premium by 75,000. Next, we need to post the income tax liability of 25,000. That goes into our liabilities section, and we also need to add the provision for the legal case, which is also a current liability. That's 40,000. Retained earnings hasn't been updated yet, but we now have all the information that we need to finalise it when we get to step 6 in a couple of slides' time. So cool, we've processed every single adjustment. All journals are now fully reflected across the income statement, the asset section of the balance sheet, and the equity and liabilities section of the balance sheet. In step 5, we need to finalise the income statement by summing up everything in our workings column, working all the way down until we can calculate net profit for the year. So let's first actually begin by finalising our cost of sales calculation, which we have at the bottom of the slide. We take opening inventory of 1.974 million, we add purchases of 6.384 million, we deduct closing inventory of 600,000, and we add on depreciation of plant and machinery of 880,000. So that gives us cost of sales of 8,638,000. Let's now move on to the income statement and start filling in the final column. We have revenue of 15,738,000 because there was no adjustments made to revenue. We have cost of sales of 8,638,000, which means we have a gross profit of 7,100,000. Now let's handle the expenses. We start with distribution costs. We were given 1,015,000 in the trial balance, but we subtracted the 60,000 insurance prepayment, which relates to the next year. Therefore, 1,015,000 minus 60,000 equals 955,000. And it's important to flag that the 60,000 reduces the expense, it doesn't increase it. This is a kind of common area where students can get in a bit of a muddle and lose marks, so keep an eye on whether an adjustment is either increasing or decreasing in expense. In this scenario, the prepayment is decreasing the distribution cost. Let's move on to administrative expenses. We're combining the original admin expense from the trial balance of 410,000. We're adding the £40,000 provision, and we're also adding the £125,000 worth of depreciation, which gives us 575,000. We have an operating profit, which equals gross profit less expenses of 5,000,000 570,000. We subtract finance costs of 300,000, which gives us a profit before tax of 5,270,000. And next we deduct our income tax expense of 25,000, which gives us a net profit for the year of 5,245,000. That completes our income statement. We've now finalised all the figures in that financial statement. So we have our net profit, which is ready to flow through to our retained earnings calculation and our balance sheet, which we'll look at over the course of the next few steps. So now that we've finalised the income statement, we can calculate our closing retained earnings by plugging in profit, because we now know what profit is because we've completed our income statement. So we had an opening retained earnings balance of 361,000. We have a profit for the period, or profit for the year, of 5,245,000, and we have dividends paid during the period of 742,000, which we deduct. So our closing retained earnings is 4,864,000. This is the figure that will feed directly into the equity section of our balance sheet, which we're going to populate now in step 7. So in step 7, we're going to bring everything together and finalise the balance sheet. Let's work through the asset section first, and then we'll populate equity, then liabilities, and finally we're going to confirm that our balance sheet is in balance. So let's start with non-current assets, plant and machinery. The carrying amount equals 13.7 million less 4.9 million less 880,000. That equals 7,920,000. Motor vehicles has a carrying amount equal to 2.5 million less a million less 125,000. So it has a carrying amount of 1,375,000, and total non-current assets equals 9,295,000. On to current assets now. We have inventory of 600,000, a prepayment of 60,000, trade receivables of 239,000, and cash of 1,085,000. So our total current assets is 1,984,000, and our total assets is 11,279,000. Let's move on to equity. On the right hand side, we have share capital of 2.1 million minus 75,000 equals 2,025,000. We have share premium of 500,000 plus 75,000, that equals 575,000. And we have a retained earnings amount of 4,864,000 as per our retained earnings calculations on the previous slide. So total equity equals 7,464,000. Then we can add in our non-current liabilities. So we have borrowings of 3.75 million. We have a provision of 40,000. We have income tax payable of 25,000. So our total liabilities equals 3,815,000, and our total equity and liabilities equals 11,279,000. In step 8, we perform one final and very, very important check. Does the balance sheet actually balance? Here we can see that our total assets are 11,279,000, and total equity and liabilities also comes to 11,279,000. So yes, fantastic. Our balance sheet does indeed balance. And obviously this is a very good sign that your calculations and adjustments have been applied correctly if your balance sheet is in balance. That said, one piece of advice I would give you is don't panic if your balance sheet doesn't balance in the actual exam. Mistakes do happen. It's entirely possible to still score really highly, even with a few errors in your long form questions. So if you find that you get to the end of your question and your balance sheet doesn't quite balance, and you do have time at the end, do try and go back and look through your financial statements and your workings, look for signs of any admitted adjustments, any duplicated entries, or a formula error. But do remember, you don't need to be perfect to pass this exam. You only need 55% to get through it. So just stay calm, be methodical, and pick up as many easy marks as you can. Don't freak out if your balance sheet doesn't perfectly balance when you get to the end of the question. Cool. So here are some of my final tips for tackling the long form scenario-based questions in the Accounting Fundamentals exam. First, I recommend you do your workings on scrap paper. It's much easier to stay organised, I think, on scrap paper than relying on the software tools. Keep your layout clear, tick off each figure as you go. I personally find it so much easier to do this on scrap paper. Secondly, don't forget to enter a 0 for any line items you believe have a 0 value. Leaving a box blank may cause the system to treat it as incomplete. So if you think a value on the balance sheet or on the income statement is 0, put in 0, don't leave it blank. Third, expenses must be shown as negatives in the income statement. You can either enter them with brackets around the number or with a minus sign in front of the number. It doesn't really matter, but the signage has to be clear so you can get the marks, and so it's obvious that the expense is reducing profit. You can't put expenses in as a positive number. You won't get any marks for that. Fourth, follow a step-by-step framework to keep your thinking structured. The long form questions can feel really overwhelming if you dive straight into them without a plan or a structure. So stick to the process that I've laid out in this question if you want to, or develop your own framework to tackle these kind of questions. It doesn't really matter, but I definitely recommend having a plan before you get into these kind of long form questions in the exam, because you can easily get overwhelmed given the time pressure that's placed upon you. Fifth, make sure you're comfortable with the layout of both the income statement and the balance sheet, because these are the only two financial statements that are tested in the long form questions. You're going to be expected to fill them in accurately, so it's really important that you know and are comfortable with what the different line items within the income statement and the balance sheet are, what they look like, what they include, what they don't include. So get comfortable with those. And finally, and probably most important, try not to panic. Mistakes do happen. You don't need to get everything perfectly right to pass. If your balance sheet doesn't balance, just stay calm. Use your time to double check your work and focus on picking up every easy mark that you can. You don't need to get 100% to pass this exam. You only need to get just over half right. So stay calm, try not to panic. And yeah, cool. Okay, you got this. Stay methodical, stay confident when answering long form questions, and keep working through the steps. Practice mock exam questions using the framework that I've laid out in this video. And yeah, I wish you the best of luck when it comes to the long form question.